Oh, there it is. Good afternoon. Let's do that again. Good afternoon, everybody. I'm Shane Deal, Deputy Commissioner from the state of Minnesota. Work within the Commerce Department. I oversee the Financial Institutions Department. And I am excited to be here. I could tell you, if my high school counselor could see me now, I'm definitely not stuck in a dead-end job. And I'm super excited to actually be here to introduce some very bright students. I'm lucky to be here, actually, to introduce the next session, to introduce the winner of this year's 2016 CSBS Community Bank Case Study Competition. Say that 10 times really quick. But after we go through this, we allow them to present that. We're going to have a grill session, so you'll get the opportunity to grill these kids on the presentation they're about to give you. And then we'll also get an opportunity to talk to the professor and their partner, Community Bank. And so I'm looking really forward to this presentation. But first, I know when the survey that we had a little bit earlier, a lot of you, this is the first time you've been here. And this is the inaugural nationwide competition, bank case competition. So I just want to give you a little bit of a background of what this is, how it works, and how we got to this point. The CSBS Community Bank Case Study Competition is a nationwide competition. Team competition for undergraduate college students. Under the guidance of their school professors, these students' teams partner with a community bank within their area. They do this to participate and create an original bank case study for this competition to submit it to us. The 2016 case study topic was small business lending at community banks. This is a very timely topic as we move forward today and have this conversation, and even more so tomorrow as we present the survey results from around the nation from new banks that participate in that. For the 2016 competition, the student teams were tasked with addressing 3 areas that related to small business banking. First, they were to assess the impact of the bank's small business lending efforts on their local community. Second, analyze how the bank's small business lending affects its financial performance. And finally, they were to evaluate the bank's management of small business lending. There were 33 student teams that showed interest and signed up for the competition in January. We had 23 student teams that actually prepared a paper and submitted it, and from that, 12 teams were picked to actually participate as finalists for the competition. From this group of finalists, and there were some really outstanding papers, great work, very interesting work that, as I said, my high school counselor definitely wouldn't have picked me to participate in this. That's for one thing, but these kids, and it's super exciting to see how interested these kids are, not only in the research of banking and community banking, but to show interest now back in a market, in an industry that for so many years we did see young, bright minds coming out, and now we've gone through a period of time, I know in my state of Minnesota, where we just don't see a lot of kids that have interest. And so it's so exciting to see these kids and all the kids that participate in this competition to present and show interest and participate in community banks and show the response for the community banks back to them. But from that, we established, out of that, we established a third, a second, and a first place winning team. And so taking third place was from the University of Arkansas, Fayetteville, advised by Dr. Tim Yeager. Second place was the University of Missouri, Kansas City, advised by Dr. William Keaton. And our first place winning team was Southeastern Louisiana University, advised by Dr. Lewis. And now I'd like to turn it over to the students from Southeastern Louisiana University, Nicholas Bird, Therese Kauzar, Joseph Edwards, and Andrea Villarreal. Kids, take it away.
Thank you so much. We're all happy to be here presenting this case study to you this afternoon. This is truly an opportunity it's a dream come true. But for more than half an hour, the night that our case study was due, we really didn't think that it would come true. We decided to make a few last-minute adjustments to our video the night it was due. So after celebrating all of our hard work over dinner, we hurried back to Nick's house to update our video and submit it. And it was the largest video that any of us have ever uploaded, so we didn't realize how much time it would take. So for almost 40 minutes, we sat there and watched the status bar on Nick's computer while the process completed, which happened to be about 30 seconds before cutoff. So We texted Dr. Lewis the whole time, and she didn't really believe us, so we sent her a video. But my takeaway from that experience is that sometimes things go wrong no matter how well you prepare. And this project was filled with deadlines. We all depended on one another to carry their own weight. And just like the night we submitted our work to the Conference of State Bank Supervisors, things go wrong and life is full of stressful situations, but how you perform during those situations is what defines you. Now back to the case study. I'm going to begin by telling you a little bit about First Guaranty Bank. First Guaranty Bank was founded more than 80 years ago in Amite, Louisiana. But its modern history began in 1993 when it was acquired by a small group of investors led by Mr. Marshall Reynolds. Mr. Reynolds had a vision to recapitalize First Guaranty Bank and build a network of community-based commercial banks located throughout the state of Louisiana, surrounding the major metropolitan areas in the state. Through organic growth and 2 bank acquisitions, First Guaranty Bank has grown from 6 branches and $159 million in total assets to 21 branches and $1.5 billion in total assets as of December 31st, 2015. First Guaranty Bank is headquartered in Hammond, Louisiana. It's a college town in the heart of Southeast Louisiana, situated at the crossroads of I-12 and I-55. 13 of First Guaranty Bank's 21 branches are situated in the contiguous parishes between Hammond and Baton Rouge. Baton Rouge is Louisiana's second largest MSA, and this is also where 80% of First Guaranty Bank's small business loans are concentrated. Another 6 branches are located outside of the Bossier-Shreveport area, which is for Louisiana's third largest MSA, and the remaining 2 branches are located between Lafayette and Lake Charles. On this map, the green circles represent the small business loans by zip code, and the orange dots represent First Guaranty Bank's branch locations. This geographical trend that I've just described to you is no accident, and growth in these smaller, close-knit communities has led First Guaranty Bank to brand themselves as the relationship bank. And it has not only led to lending opportunities within these smaller communities, it's also attracted customers from the larger, more densely populated areas that are nearby, because at the end of the day, customers crave personal relationships with their bankers, and that's what First Guaranty Bank offers them. First Guaranty Bank management and Mr. Marshall Reynolds believe that they have an obligation to give back to the communities that they operate in. Through our research, we discovered that 2% of pre-tax gross income is dedicated to contributions that go back to these communities. And this has remained throughout Mr. Reynolds' tenure, even as First Guaranty Bank's pre-tax gross profit has risen from $1 million to $12 million. Their lending practices encompass the values that community banks strive for. And we found some examples of how they pass savings along to their customers. They offer free appraisals on their loans, which for real estate loans can range from up to $1,000 to $10,000 for larger loans. And they offer low rates, as low as their sound credit policy will allow. First Guaranty Bank has a goal to keep Louisiana communities vibrant, and the effects of their small business lending have rippled throughout the community, or throughout the state of Louisiana. Now I'm going to turn it over to Joseph so he can talk to you about the economic impact study that we did.
Hello, everyone. Before I begin, I want to say 2 things. First, hi, Mom. Second, I don't know if there's any basketball fans in the room, but sometimes at halftime of NBA games, they bring out the little kids to play about 10 minutes of biddy ball. And with all these great researchers and academics in the room and all this industry knowledge, I feel a little bit like the kids playing the biddy ball. However, the thing about the biddy ball is half the time it's better than the actual NBA game. I don't know if that'll be the case here, but I hope you enjoy what we all have to present. From our very first brainstorming sessions, we knew the question about the bank's impact on the community would be the centerpiece of our paper and presentation. But the question seemed kind of open-ended and qualitative at first until we met with Dr. Lewis, our mathematical mind who views the world in terms of econometrics. So she read the question and she said, I think we should try to quantify this. Y'all should do an economic impact study. And our eyes kind of got big and we all nodded along, but really none of us knew what she was talking about. This wasn't something that we had ever learned in any class we had. But she gave us some literature on the subject and eventually got Dr. Deck Terrell, a Louisiana State University professor of PhD economics. So he came and gave us a lecture on the subject, and Dr. Terrell has performed over 100 economic impact studies for the state of Louisiana, as well as firms operating in the state. The example he gave us was actually his impact study for the 2013 Super Bowl that was hosted in New Orleans. So that was a pretty interesting real-world example to follow along. So what is an economic impact study? This type of study utilizes input-output modeling to measure the revenue, earnings, and jobs created from a particular business activity. In our case, the business activity was First Guarantee Bank's small business lending. The idea is to capture a phenomenon called the multiplier effect, or how $1 invested in a certain sector ripples to different but related sectors. The parameters for the actual ripple effect are estimated by the United States Bureau of Economic Analysis. So to perform our study, we needed a considerable amount of loan level data, which would have been difficult in probably any other case, but we had a few special circumstances that allowed the bank to trust us with the data. First of which, the chief credit officer is a Southeastern alum. Probably 10 to 15 years ago, he was sitting where we are in our shoes. I mean, obviously not at this table, but as students. Second, probably over half of the employees in First Guarantee's credit department are Southeastern alumni. And third, at the time, I was actually an intern in First Guarantee's credit department. At the time, we decided to do the case. So it was just kind of the perfect storm that allowed the trust to be developed for them, a newly publicly traded bank, to give us this data to perform this study. So the steps of the study are as follows. First, we needed some kind of estimate of the revenue created from First Guarantee Bank's loans. So we took each firm's, we got loan level data from 744 firms, which totaled about half of First Guarantee's $250 million portfolio. Only about 100 of those had complete data, so that was about 14% of their total portfolio. So that was our sample size. So first, we needed an estimate of the revenue created by each of First Guarantee Bank's loans. So we took the original loan amount and multiplied it by each firm's total asset turnover to get an estimate of how the investment was turned into revenue by each firm. Second, we pulled the created revenue by industry group because it had to be compiled into industry group to be run through the Bureau of Economic Analysis's model. Third, we just ran the data through the model. And fourth, we totaled the results, and those were our numbers. However, since we only had a smaller sample of their total small business loan portfolio, we scaled up our final results, which, remember, were just from those 100 loans, to represent their entire small business loan portfolio effect. So on this page, you can see these are the major industries that First Guarantee had an effect on through its small business lending portfolio. And in our analysis, we estimate that the largest impact came in the retail trade sector, with over $400 million in revenue created, over $130 million in additional earnings and wages created, and over 4,200 jobs. The second largest impact was in the wholesale trade sector, with over $170 million of revenue created, over $15 million of additional earnings and wages created, and over 1,000 jobs created in this sector. And the total numbers were, we estimate first guarantees, small business lending activities to have created over $1 billion in additional sales in the state, over $300 million in additional earnings, and over 8,600 jobs, all of which is focused in the state of Louisiana. It's easy to look at the numbers and say, yeah, that's really impressive. That's a lot. But we wanted to get a personal feel for the effect. And so we did this by going into the community, actually interviewing some of the businesses the First Guarantee has financed. And it was really a rewarding experience. And one case especially sticks out. And we interviewed a couple that started a daycare outside of Hammond called Little Country Bumpkins. And they had gone to a couple other banks looking for a loan, kind of looked at their history, said, credit history is great, but you don't have any business experience. But First Guarantee saw an opportunity to lend to a couple with great character. So as we're interviewing this couple, all the kids are running around. There's employees that maybe wouldn't have had jobs otherwise. I mean, hopefully they would have had jobs otherwise, but this was all enabled by First Guarantee. So seeing this up close and personal really drove these numbers home for us. Next, I'm going to turn it over to Therese to talk to you all about the financial performance aspect of the case.
Thank you, Joseph. In order to analyze the effects of First Guarantee Bank's small business loan portfolio on financial performance, we needed to first analyze their overall financial performance. We did this by performing a return on equity decomposition. We also developed 4 peer groups to compare First Guarantee Bank to. And Dr. Lewis was adamant that we had to be able to defend our peer groups. So after 2 months and a lot of going back and forth, a lot of hard work, we believe that the 4 peer groups that we've designed are defendable for several reasons. Each group contains banks ranging from $1 to $2 billion in assets. Banks similar in size likely share common regulatory requirements and similar scale economies. 2 of our peer groups are Louisiana specific. Louisiana is unique in many ways, so these banks have common challenges and economic environments. We also separated the Louisiana banks by whether or not they are publicly traded, because First Guarantee Bank recently went public at the end of 2015. And since First Guarantee Bank has such a large securities portfolio, we decided to expand our reach to the Dallas and Atlanta Federal Reserve regions to sort by securities portfolio size. One group consists of banks with securities portfolios larger than 28% of total assets, while the other consists of banks with securities portfolios smaller than 10% of total assets. So right away, we noticed that First Guarantee Bank's ROE underperformed most peers since 2010, with the exception of Louisiana publicly traded banks. So we wanted to know why. The next place we looked was leverage. We used the equity multiplier ratio to measure this. First Guarantee Bank has had consistently higher leverage than its peers. However, they've converged around, well, all of the peers have converged around the same levels. And if anybody needs help seeing, First Guarantee Bank is the royal blue line on our charts. So all of the peers have converged around the same levels during this time. So we knew that it had to be an ROA issue, a lagging ROA that was leading to this underperforming ROE. ROA breaks down into 2 main components: asset utilization and profit margin. We quickly realized that First Guarantee Bank's asset utilization is a driver of their lagging ROA. This is because of their composition of assets. Between 2005 and 2009, First Guarantee Bank's composition of assets was on par with most peers. However, that being said, that their loans and leases to total assets was around 70%, and their securities portfolio was around 15% on average of total assets. So in their asset utilization and profit margin was also more comparable to peers during this time. So during one of our interviews with First Guaranty Bank management, we learned that First Guaranty Bank predicted trouble in their loan portfolio following the financial crisis. So they made a decision to reduce their exposure to these more risky loans and put money into a smaller or lower risk securities market. So in 2009, First Guaranty Bank increased their securities portfolio to 28% of assets. 2010, that total increased to 45% of total assets. In 2011, that increased to 51% of total assets. Past UBPRs tell us that First Guaranty Bank's small business loan portfolio averages a yield between 4 and 6%, while their securities portfolio averages around 2%. Some could argue that First Guaranty Bank made too strong of a push into the securities market following the financial crisis. But the truth is that no one knew the extent of the financial crisis or how terrible the extent would be. And First Guaranty Bank made a decision to reduce their loan credit risk by reallocating money from higher risk loans to lower risk securities. They do, however, make up ground on cost control. They have an above average profit margin and an outstanding efficiency ratio. This is because First Guaranty Bank can double the size of their securities portfolio without adding any personnel, any staff. But if they were to double the size of their loan portfolio, they would have to, grow their staff, on every tier, every level, in order to handle that volume of work. So, because of their asset composition, First Guaranty Bank has become one of the most efficient banks in the state of Louisiana. Now I'm going to hand it off to Nick to discuss First Guaranty Bank's participation in SBLF.
So Therese discussed a little bit about why First Guaranty moved or reallocated their funds from their securities portfolio into small business loans and loans in general from 2011 to 2015. But we really wondered how they went about doing this, so we started to explore that. And I remember I was thumbing through an annual report and I saw a section on their small business lending fund participation. So we scheduled an interview with Mr. Randy, the Chief Credit Officer Joe described earlier, so he could tell us a little bit about what this was. We had some questions on it. And he basically described it as it was one of multiple sources of low-cost funding that they use to supplement their growth of their small business loan portfolio. And the 2010 Small Business Jobs Act is what established the SBLF, and it was designed to do just what Randy said, provide the low-cost source of funds, and this would then encourage small business lending through their participating community banks. I did read a Federal Reserve paper that they used simple regression estimates to prove that the participating banks increased their small business lending by 10% versus non-participating banks. So what the SBLF does is they would purchase $1,000 par value of preferred shares in the bank, equivalent of 3% of their risk-weighted assets. And that's for banks from $1 to $10 billion in assets, which First Guaranty is in that threshold. And the banks were initially required to pay a quarterly dividend of 125 basis points. But this rate would fall to 25 basis points once the bank reached their 10% growth target. And the banks would also supply quarterly reports to the SBLF, so this actually provided a large amount of data we used to analyze the small business lending at the bank. For loans to qualify as into their criteria, they have to fall into one of 4 categories, namely commercial and industrial loans, owner-occupied commercial real estate, agriculture loans, or farm loans. And in the interview we had with Randy, he told us that luckily for First Guarantee, these were areas that they already specialized in due to their geographical presence. He used an example of their Abbeville branch, which is in a rural area, and how their loan officer had family ties that go back generations with their farmers and the agriculture producers in that area. So this helped the bank achieve that 10% growth rate that lowered the dividend rate to the minimum amount. And they received it in less than 2 years, so they wound up having around 3 years of very low-cost funding, 1% annually on $39 million of capital. And this is just one of multiple sources of funds that they used to increase their small business lending by $54.4 million from 2011 to 2015. And this is just, to me, it's one example of how the community bank business model can be utilized, in this case by the government, to help to benefit local economies and local small businesses. And I'm going to move on and talk a little bit about the small business lending management, and specifically I'm going to talk about their interest rate risk management. So improving the financial performance is not the only function that the bank's expanding small business loan portfolio fulfills. First Guarantee's management forms strategies to deal with their exposure to macroeconomic and statewide risk. Specifically, the bank's portfolio allocations and their loan structure, along with the level of interest rates and the shape of the yield curve, impact the bank's market value of equity and net interest income. As we encountered a flattening yield curve throughout our study, we found that it placed pressure on the bank's net interest income margins as the income spread between the bank's long-term assets and short-term liabilities shrinks. We found that the increased allocation into their small business lending played a vital role in their broader strategy to deal with these tighter margins that were associated with the movements of the yield curve. We also, in our paper, we did discuss the duration gap analysis a little bit. However, we couldn't actually do this analysis as we weren't able to be provided with data on the firm's or on the bank's liabilities and deposits because of their customers' right to financial privacy, obviously. Nevertheless, we do use the loan data to find that the loan level data to find that about 73% of the small business loans were fixed rate, and we were kind of surprised by that, as we thought it might increase interest rate risk. But then we went on to calculate the weighted average time to maturity of the portfolio, and it wound up being only 3.7 years. So this kind of put it into perspective to deal with the interest rate risk associated with the large amount of fixed rate loans. They structure their loans with shorter times to maturity to deal with that. We also learned a lot in the interviews that we did. We did multiple interviews with the bank's management, and they told us a lot about their policies on how they manage interest rate risk and what they do internally. And I found that a lot of what they said in the interviews aligned with what President Evans discussed earlier regarding the sensitivity analysis. And specifically, they said they started more recently. They started using broader measures or broader ranges of scenarios of interest rate scenarios with their sensitivity analysis. And that was our section on interest rate risk. And I'm going to let Andrea talk a little bit more about their credit risk management.
He lied. It's me that's talking about credit risk management.
Both of them.
Yeah, she's after me. The second major risk that any bank faces, as all of you are aware, is credit risk. There have been some special circumstances in Louisiana over the past few years that we felt we needed to address. The first of which being Louisiana's budget has been in a state of crisis for going on 8 years now. And over again, Louisiana's legislature has made cuts to both higher education and healthcare. But recent revenue shortfalls due to the depressed oil prices over the past year or two have led the legislature to have to make more cuts, but they're kind of out of room in those higher education and healthcare sectors. So what have they had to do? They've had to raise taxes pretty much across the board, some on consumers, but also some on small and large businesses alike. We believe that this does make the overall economic climate potentially more risky moving forward, as this could, stunt economic growth and potential small business development. However, even with these recent developments, First Guaranty's management is confident in the stability of their portfolio and future growth prospects for several reasons. The first of which is that even with these developments, they haven't seen any kind of spike in delinquencies or slowdown in demand. I mean, Nick just told you from 2011 to 2015, they've increased their small business lending by 39 million, I believe it was. 54 million. Nice. Okay. Second, although the sector certainly isn't what we Louisianians would like to see, oil prices have come off of their February lows of $29 a barrel, so that bodes a little better for the state. Third, through the loan level data we received, we were able to discern that First Guaranty's small business loan portfolio is diversified very, very broadly across many sectors. So that always helps. If there's a slowdown in one sector, that could bode for opportunity in other sectors. And fourth, management assured us that they were confident in their credit underwriting process because they're management, they have to be. But we wanted to test them on that final point a little bit. So I'm going to let Andrea tell you a little bit about the statistical analysis.
I just want to say one thing, and it's not hi, Mom. She told me she couldn't watch. But please excuse my accent. I've been told that when I speak in public, it comes a little bit stronger. So, okay, so even though management believes that their credit underwriting process is effective, it was our goal to use statistical modeling to predict which loans would become problematic in 2013 and 2014. All of this in an effort to improve this process. We used 3 different models in order to meet this goal. All of these models were new to us, with the exception of the value at risk analysis, which we had touched on in one of our finance classes. Our first objective was to compute a variation of Altman's C-score adapted for privately held firms in an effort to predict which loans would be late. This model uses 5 weighted financial ratios to predict bankruptcy 1 to 2 years in the future, with an accuracy between 72 and 90%. Fortunately, the sample data that First Guaranty provided to us had the necessary information for us to first compute the ratio and then the C-score, and after calculating it and comparing it with the standards of 2.9 or greater being in the safe zone and lower than 2.9 being in the gray or distress zone, our results showed that, surprisingly, only 45.83% and 52% were correctly identified by Altman's model in 2013 and 2014, respectively. Due to the fact that Altman's model clearly underperformed expectations, we employed Stata software to find statistical relationships between financial ratios and loan problems, using probate regressions. From each loan, we gather information, including whether the borrower had paid late before, the number of times, and the percentage of times that the borrower had paid late since origination. All of these to be used as dependent variables. This was the first time that I ran a regression using a program other than Excel. Running a regression in Excel versus actually having to write code to run a regression in Stata are two totally different things. Thankfully, I had programmed before in Java and Visual Basic, so I had somewhat of an idea on how to read status code, and learning how to write it to run a regression wasn't extremely hard in the end. It was only a matter of time until I was running one regression after the other, actually texting Dr. Lewis every time I ran one. I'm trying to find anything significant that would indicate that we had found a better model for the credit underwriting process. Unfortunately, when employing more than one ratio at a time, using the same ratios as Altman's formula, we found few statistically significant relationships because only 98 out of the 744 loans had complete financial data. The lack of variation in the data caused significant multicollinearity problems among the independent variables because they were highly correlated. Although not statistically significant, we found evidence of intuitive relationships among multiple ratios, snakes, codes, and the three dependent variables previously discussed. We believe more complete data would produce statistically significant relationships that would prove enlightening. However, we found three noteworthy pieces of evidence that did test statistically significant in simple univariate analysis. The first one is that surprisingly risky NAICS codes associated with cash-intensive businesses reduce the chances of late payments. These codes include businesses such as convenience and gas stores, liquor stores, restaurants, and among others. This result was shocking at first, but then it all made sense when we also found out that businesses with higher working capital to total assets had a lower percentage of late payments, as well as lower chances of paying late in the future. And our last piece of evidence is that businesses with higher earnings before interest and taxes to total assets also had lower chances of paying late. Our final model consisted of looking at First Guaranty's provision for loan losses to total loans relative to peers. The graph shows that the financial crisis had a hard impact on First Guaranty, but they have recently performed equal to or better than most of its peers. First Guaranty managed to increase their total loans while also decreasing their average provision for loan losses, which is a difficult feat to pull off at the same time. In order to define a worst-case scenario for First Guaranty's provision for loan losses moving forward, we conducted a value-at-risk analysis. Personally, I had only heard of this model once in one of my finance classes, and I had always wondered what it actually entailed. Having to conduct this analysis to find useful information for a bank was indeed enlightening. So we analyzed their provision for loan losses to total loan ratio for 44 quarters starting in 2005, and we assumed a normal distribution. After calculating the mean and the standard deviation, the results revealed that allocations to provision for loan losses would need to be 0.8% of total loans in a worst-case scenario quarter. According to the most recent SBLF data, First Guaranty's small business loan portfolio totaled over $253 million, and using a 99% confidence interval, we anticipate that approximately $2.13 million would need to be dedicated to the provision for loan losses for most small business loans in a worst-case scenario quarter that would occur once in every 100 quarters.
So we ran out of time, so I'm going to shorten this up drastically. We were going to thank all the people, but I want to make sure CSBS and the Fed knows that we thank y'all a lot for this opportunity. Y'all really made the difference, made this a great experience for us. Specifically, thank you, Ms. Raquel, Mr. Eldar, Mr. Jim. This has really been a great experience for our team, and thank y'all for listening.
All right, congratulations. So very well done. I do want to give each and one of you an opportunity. Would you please introduce yourself, tell us what year you're in school or what you're doing now, what your major is, and give us a reason why you decided to participate in this competition.
Hi, I'm Therese Kauser. I am a senior at Southeastern University, Southeastern Louisiana University. A little nervous here. And I'm actually expecting to graduate next summer, and I have had an interest in community banking for a while. I've worked at a community bank, a First Guaranty Bank, for a while, but I haven't had the exposure to much, except for I go in and do what I'm asked to do, what I'm tasked to do. So being able to see things outside of my everyday job, that was exciting to me. And participating in this competition gave me that opportunity. Oh, one more thing. Southeastern does not have a banking course. So this did enrich our educational experience because we otherwise would not have learned any of these things if it were not for this competition.
Hi, I'm Joseph Edwards. I graduated from Southeastern in May, and I'm a first semester Master's of Finance student at Louisiana State University now. But I think I'm going to drop out and submit my resume to be the football coach. There's a lot more money in that, I hear. I'm not a big football fan, but I decided to compete in the competition because she asked me to. And I went back and forth on it a lot because I had a pretty hefty undergraduate career. I was running track and field and also in 18 hours trying to take on 2 minors as well as my finance degree. So I had a lot on my plate, but after thinking about it and then also after completing my internship with First Guarantee, I knew there was more knowledge to be learned, I guess, about the small business and community banking business model. And you can tell I'm a master's student now, so I love learning a lot. So I felt like it was just the optimal opportunity to do so.
Turn. My name is Nicholas, and I did this for the money because the winners receive $1,000. It's not the only reason, but that's definitely one big factor. I did it for basically the same reasons that they said before, but another thing is being a student at a smaller state-funded school, it's kind of harder to stick out in the job market or after you graduate, and even with a good solid resume and the likes. But it's opportunities like this that allow us to stick out, and it's been really good for our university. Other students come up to me all the time and they ask us how we're doing on it, and they say congratulations after we won and stuff. But it gives this other students confidence that just because you go to a smaller school doesn't mean you can't compete with on a nationwide scale. And I think it just really, this competition in particular has really benefited our finance department a lot. But I'm sure they've already formed multiple teams for next year's competition. So that's pretty much covers the reasons why we did it and the other stuff.
I'm Andrea, and my last name is Villarreal, but I get either Villarreal, so pretty much however you want to call me is fine. The reason why I got into this competition is also because Therese asked me to, but I was part of the Southeastern's tennis team, so I wanted to leave my senior season to be the least heavy because I wanted to focus on tennis. So I was enrolled in 12 hours, and she presented this opportunity to me. I was thinking about it, and I'm like, should I do it? And then she told me, it's a semester-long competition. It's just a 25-page paper, 10-minute video. We can do it in 1 week. Of course not. So whenever I'm presented with an opportunity like this, it's really hard for me to say no. So I agreed to do it, and then it felt like I had a 30-hour semester instead of only 12. But I can definitely say it was worth it in the end. Like Therese said, we don't have a banking class. And when I enrolled in Southeastern, they still had electives. So I was planning on having the bank and administration class that she used to teach. But then they removed it, so I was, okay, then I guess this is a pretty good opportunity for me to learn more about banking. And yeah, that's basically why I decided to get into this competition, which I don't regret at all. I've worked in a lot of projects with Joe, so we kind of knew like we were going to get this straight and do our best, because that's what we always do. So, and I'm really thankful for being here and being able to present it to you, and I hope you enjoyed it.
Well, thank you, and I know I'm glad that all of you did it. I hope that you found, it sounds like you learned a lot about banking. It's unfortunate that we have universities that don't teach banking anymore, but unfortunately I think you're in the majority, not the minority, when it comes to that status. But Professor Lewis, could you just give us kind of a quick background and an idea why you chose to lead this team?
Well, I think I got a rather benign email from my dean, which had been, I think it was Raquel Johnson that had emailed her. So I remember Therese, who had been in my first corporate finance class. She was bemoaning the fact that we had to revamp our curriculum, and that meant that all of our electives were going to have to go. And so banking was one of those. And so I just emailed it to Therese, and she showed up in my office, I bet 5 minutes later. She said she wanted to do it, and I said, well, get a team, and I'd be happy to sponsor you. And my passion is banking. My research areas are banking, and so I think it was a very worthwhile thing to do.
Well, we do appreciate it, and thank you for taking the time to work with these students. It means a lot. Mr. Lewis, could you give us a brief introduce yourself, and then tell us why you agreed to partner, to be their partner community bank?
Well, I'm Alton Lewis. I'm the president and CEO of First Union Bank in Hammond. I practiced law for a long time, and 7 years ago I covered First. They asked me to come into the bank to help manage the bank, and I've been doing that for the last 7 years. The first thing, you have to understand students. Not a single one of them is just a student. You have a varsity tennis player who's academic All-American, right? You have a varsity track and field, and if y'all have any idea of the demands of varsity sports on the college level, it's incredible. You have a guy who has at least 2 jobs in addition to going to school, depends. You have a lady who's got a family, who's got a job, who's also going to school. And this is incredible. So, and then you have a professor whose budget's been cut for 8 years in a row. So, I mean, what they did, what the 5 of them did, is incredible. So, I mean, we thank you. And we were just given an opportunity to support them and support our community, and that's why we did it.
Great. Now is the opportunity for you to ask questions, grill them, dig deep into their paper, and really question what they were thinking.
Are we done?
Before you ask questions, would you dunk on a little kid playing biddy ball? I don't think so. I don't think you would.
I don't know. I'm from Minnesota, so we play in between periods, and we would check them. So just to give you an idea. So do we have any questions?
Hi, my name's Rick Sanborn. I'm a banker in the group. And Alton, the question for you, the ALL analysis that was done by the team showing that you only needed 0.8 reserves to loans, has your regulatory agency bought off on that?
Well, the small business loans were a lot higher quality than the other ones, so we made it up in other places.
So can we get a copy of that model as bankers?
Ray?
Rick Grace, Commissioner of Banks, North Carolina. I'd just like to know if any of y'all are interested in a job in bank regulation.
Didn't mention I was graduating. So
Well, I got first dibs. Minnesota's weather's just a lot like Louisiana. You won't tell much difference. We have any other questions?
First, I want to congratulate the panel. It was a really interesting presentation, and I think certainly stood up well to the professional presentations we heard earlier. But I had a question about your Alton score analysis, and you're looking at the loan loss reserves. Is there anything that came out of that analysis that was interesting to the bank or impacted the way they thought about rating their loans?
To whom were you directing the question?
Whoever wants to take it.
Well, Andrea.
Okay, when we conducted the analysis, we have these three zones, the one of the safe zone, the gray zone, and the distress zone. So what we were looking for was to see how they weren't going to tell us their credit underwriting process per se. They only told us that they follow the 5 C's. So we wanted to see, based on this, using these ratios, how alike it was from Altman's C-score. But like I said, unfortunately, it seemed like I was running through it, and one would say that the C-score, it should default, and it hadn't default. And that's why the results show that only 45.83% in 2013 was correctly identified by Altman's model. This in turn didn't help us because we couldn't really find a better model for us to propose to First Guarantee Bank.
I lost my train of thought. I was just going to say that I don't think the bank really took anything major from our conclusions because they're obviously working with the complete set of data, whereas we just had this little snippet that they had sent us, and we were just trying to kind of piece together anything we could to make an interesting paper for you all to read. So I don't think they really looked at anything we did and were like, oh yeah, we're going to use that.
Well, if I can respond, we did look at what they did.
Talking to the wrong people.
You're doing the right thing. No, we did look at what they did, and like the Altman thing, at first blush, it seemed like something that would be very attractive. But when we did analyze what they had to look at in the data, we didn't feel like it, in the end result, would really give us a lot of benefit.
Commissioner Ducre.
So John Ducre, Commissioner from Louisiana. So I just want to commend you all for following through on this. Your area of the state was one of the hardest hit in the flooding. So I don't know if any of y'all personally flooded, but it was a terrible impact in that area. So thank you all for following through on this.
I'd like to interject here. The money issue that Nick was interested in, I think bought him the suit. He lost all of his clothes.
Yeah, I was renting a house, it flooded, and then I evacuated to my parents' house, and it flooded just like 3 days after. I'm from Denham Springs, which I think 90% of the homes there flooded. So yeah, my city's been completely devastated. But thank you.
$1,000 helps.
Any other questions?
Russ Cation, University of Wisconsin Whitewater. I honestly wanted to mention my team entered this, and there's going to be hell to pay in Wisconsin because the quality of these all four of these, made my students look like cave drawings. So, good job, guys.
If there's no other questions, I do have a couple of questions, if you don't mind, and one goes to you, Mr. Lewis. How has this experience shaped your view of the impact your bank has on the communities that you serve?
Well, when you do an economic impact analysis like this, it really shows you how much the bank really means to the community. I mean, we've had the feeling that, when we make small business loans or when we make loans to individuals in our communities, that it's a positive impact. But this showed us exactly financially, quantitatively, what it's doing, and that has encouraged us to continue our efforts. And as a matter of fact, we're going to do some marketing based upon the idea that businesses should borrow money from us instead of the big guys, because the money stays here and we're their customers. So
great. Ron?
I'm just curious what the four of you were thinking of your career plans prior to this, and then whether any of you think you would maybe like a career in banking following this experience.
Absolutely. If, like I said, I'm graduating. If anybody, my email is to that name. SEOU.
Yes, I was interested before the competition, and if anything, I'm more interested now. So yes.
I would say yes. I've had an interest in community banking for many years, and this has encouraged me to go into more of the analytical aspects of banking, but absolutely yes.
And it's hard for me to answer this question because, like I told you, I was a student athlete. I was part of the tennis team, and I had a really good record. So I kind of went through. I'm going to go shooting for professional tennis player right now. And I think it's the best time to do it because I just got out of college. I got my degree. Now I can wait for a little bit, but if it doesn't work out, then I'm completely interested.
Do you need bankers to sponsor your career?
Oh, totally. Oh, yeah. I can get any sponsors right now.
Well, once again, can we give them a round of applause? Good job, well done. But really, for those of you that are interested in reading their case or any of the other case studies that were presented during this competition, you will find them, and all of you should have received a hard copy of the CSBS's Journal of Community Banking Case Studies, Volume 1. And just another little addition, both myself and this team will be available to autograph this inaugural case study after today. But it's also available online, too, so you can, on the website for the case study competition website. I do want to go ahead and just look ahead. Believe it or not, we're already looking ahead for 2017, and so we have opened up the opportunity for the next bright and great students to if they can, one-up this group, which is going to be a big challenge. But it has already opened up. It did for all the schools to sign up for it. It is a January deadline again. So we do ask the regulators in the room, the bankers in the room, to go out and reach out to your institutions. You can see what happens. You get them involved. You get them interested. You get both the bank and the students an opportunity to really see how impactful they are to the communities that they work in. This year, or next year's topic will be specifically driven by address management and board succession at community banks. Specifically, the students will be tasked with analyzing the strengths and weaknesses of bank's leadership succession plan, analyzing bank's process to identify, advance, and prepare employees for future leadership positions, identifying any correlation between the bank's profitability and performance, leadership succession preparedness, and the development of new products, revenue sources, and technology adoptions. And finally, among other things, the students will be tasked with developing recommendations for the bank to consider in executing a succession plan for management and the board. And just to throw you out some statistics that a lot of you already know, but probably will scare you, somewhere around 3/4 of all bank CEOs are over the age of 50. Nearly 30% are over the age of 60. And to add to that, at any given moment, 30 to 40% of senior executives in banking are at risk of retirement in the next 5 years. So as you can tell, this is a very timely topic. There's a lot to it and a lot of complexities. And as we know, bright minds have the ability, I think, to really start to dig through it and give us the ability to look forward and see what the next generation thinks about us old timers getting out of the industry. So once again, thank you to all of you. Congratulations. The suit looks great. I hope you learn how to dunk. And tennis team, and everything else. Thank you. Everybody, one more round of applause.